The world of futures and options in Chicago is a big business. I will give you a case in point. Last year, the Chicago Mercantile Exchange traded more in terms of notional, if that's the word, value in the first 2 weeks of the year than the New York Stock Exchange did in the entire year. That is probably why when John Thain, the chief executive of the NYSE, when he was looking for a role model in terms of taking his exchange public, he did not go to London or Tokyo or even to Wall Street. He came to Chicago. Well, enough of all that. Let's introduce our three guests. First, and when I call your name, take your seat behind, well, if you want to switch them around, that's okay too. Number one, Terry Duffy. How about a round of applause? Mr. Duffy has served as chairman of the board of Chicago Mercantile Exchange Holdings and CME since 2002. CME is recognized as the world's largest derivatives exchange and was the first U.S. financial exchange to go for profit in 2000. I could go on, but we want to save some time for the speeches and the questions. Number two, Charlie Carey. Chicago Board of Trade. The Chicago Board of Trade successfully completed its transformation into a for-profit publicly traded company, and Charlie was reelected for a second term as chairman. He has deep roots in Chicago, as both his grandfather and uncle have served as chairman of the exchange. Number three, Bill Brodsky. Has been chairman and chief executive officer of the Chicago Board of Options Exchange since 1997. The CBOE is the founder of the listed options business and is the world's largest option exchange. It is home to more than 1,700 individual equity options, et cetera, et cetera. We could go on, but you didn't come here to hear me. Most of you didn't come home here to hear me. So let's get going. Between 5 and 7 minutes each. Terry Duffy, you could sit there or you can come up here, whatever you find most comfortable. Let's have a round of applause for Terry Duffy.
Thank you, Paul, for that kind introduction, and I'm really pleased to be here along with Charlie and Bill, two of Chicago's esteemed business leaders. I want to thank you and all the members of the City Club of Chicago for allowing me the opportunity to give you a little background on the CME. Also, I'd like to talk about the role of the CME and Chicago in the development of the financial marketplace. Historically, Chicago has been known around the world as the Windy City, or as Carl Sandburg said, the city of big shoulders and hog butcher for the world. Today, Chicago is known as the global leader in the field of derivatives, called futures and options. Chicago's futures and options exchanges, the CME, the CBOT, and the CBOE, are the dominant reasons that Chicago is positioned as a global financial hub. In fact, the derivatives industry has a large impact on the economic well-being of Chicago, the state of Illinois, and our nation. The Civic Committee, as Paul pointed out, of the Commercial Club of Chicago estimates that more than 150,000 jobs are generated by the exchange community. Chicago has become the center for global derivatives. Futures and options have now gone mainstream and are considered essential tools for today's portfolio managers, investment bankers, and chief financial officers. For those of you who may not be as familiar with our industry, futures and options markets can be best thought of as giant insurance companies. We facilitate the transfer of risks that impact financial and non-financial assets. This includes everything from stock market price movement to foreign exchange rates to interest rates, even the changes in prices of commodities. And these products are used primarily by large global financial institutions. However, they benefit us all. Let me give you a few examples. Our interest rate products helps reduce the cost of borrowing and financing by enabling banks and other lenders worldwide to hedge interest rate risks. This makes it more cost efficient for people looking to take out a mortgage for their home. Our equity products enable investors to better manage stock market exposure. This in turn increases investor confidence and overall participation in those markets by managers who oversee your pension fund or 401k. The CME is also the largest regulated marketplace for foreign exchange products, including all of the world's major currencies. The ability to hedge foreign currency risk is particularly important because it helps facilitate cross-border trade and commerce. And yes, We still trade futures contracts based on cattle, hogs, pork bellies, dairy products, and lumber. These products play an important role in the risk management for our agriculture economy and ultimately for all of us as consumers. As you can see, these products having a very important effect on our economic lives in very, very positive ways. Indeed, futures and options have become a global growth industry. They have grown at a compounded annual growth rate of 38% during the last 3 years, compared with relatively flat growth in the world stock markets. And by comparison, the over-the-counter markets have grown at a rate of 28% during the same time period. Also, there are a number of long-term secular trends that will continue to drive growth and innovation in derivatives. For example, the global political and economic climate has become increasingly uncertain, which creates a greater demand for hedging needs. At the same time, investors are becoming increasingly sophisticated concerning derivative markets. And perhaps most important, there has been a significant shift away from the passive equity investments to trading derivatives that are generating higher than average returns for investors. And it's big business. Let me put it into perspective for you. So far in 2005, the CME has cleared almost 1 billion contracts worth $500 trillion. That is more than 10 times larger than the U.S. GDP. And as Paul was saying, put it another way, the CME trades more during the first 2 weeks of January than the New York Stock Exchange will in an entire year. By nearly every measure, CME today is the largest derivatives exchange in the world. We also are the largest clearing derivatives house in the world. When you facilitate the transfer of $500 trillion of risk, and you have to guarantee the performance of each of those 1 billion contracts, there's quite a bit of exposure that has to be carefully managed. And that is a critical part of what we do. We hold $40 billion of collateral to support the transactions made in our markets. We move between $1.5 and $6 billion of funds to and from market participants each day. And much of that banking activity happens right here in Chicago. That's not bad for a 107-year-old Chicago firm that started trading butter and eggs. And by way of background, let me give you just a brief overview of the innovations that have made the CME the marketplace leader it is today. We evolved beyond agricultural commodities starting in 1972. That's when the CME invented the world's first financial futures contract by introducing futures on 7 foreign currencies. This was a breakthrough idea conceived by our chairman emeritus, Leo Melamed, with the help of Nobel Prize winning economist Milton Friedman from the University of Chicago. It revolutionized the futures industry. Today, 99% of what we do involves financial instruments. We also were the first to launch a global electronic trading platform for financial derivatives called CME's Globex. Today, 74% of all transactions at the CME are executed electronically. The CME Globex platform is available 24 hours a day around the world. Confirmed trade executions takes less than 0.2 of a second, which is less than a blink of an eye. We also were the first exchange to embrace a new paradigm for the 21st century. In 2000, we became the first U.S. exchange to demutualize from a membership organization to a for-profit company. And in 2002, we became the first financial exchange in the United States to become a publicly traded company. The CME is traded on the New York Stock Exchange and the NASDAQ. Our stock price has increased tenfold from the December 2002 IPO price of $35 to roughly $370 today. With a market cap of nearly $13 billion, we are now the 17th largest company in all of Illinois. The success of the CME has not gone unnoticed, but nothing really captured the essence of what we have achieved at the CME as much as a headline that appeared in the Chicago Tribune on April 24th of this year. It appeared in the aftermath of the NYSE announcing its plans to go public. The headline read, and I quote, "The Merc was the model for the NYSE." The bottom line, America's financial markets have shifted from the East Coast to Chicago, where our exchanges are transforming the global marketplace. Let me conclude simply by saying that I believe that more than any other factor, it is our commitment to innovation that has enabled the CME to become a leader in the global capital markets. It is a position we intend to keep and build upon in the years to come. I thank you for inviting me today, and I look forward to answering your questions. Thank you.
That was Terry. I don't. For those of you who don't know, Terry and I were pals going back to 1983 in the hog pit. That's where we met. And Bill, I think you were working for Clayton Yeiter at the time, or who was the president? But it's an honor to be here today. When I look around the room, I see Leo Malamed, Jack Sander, my good friend Terry Duffy, Bill Brodsky, people I've been working with for a long time. But Jay, you introduced some people earlier, and when I think back to my involvement, I don't think I would be standing here today as chairman of the Board of Trade if it wasn't for somebody sitting right here who encouraged me to get involved when I really had questionable interest of getting involved. But I'd say Tom Donovan, we were very pleased that that snowstorm occurred because he came to the Board of Trade as secretary, and within a couple of years he was our president and CEO. He was a strong leader for the exchange. He was a calming influence when we were under attack, and I would say that he was most influential in me getting involved in the board of directors and becoming chairman of the exchange. So I just wanted to recognize Tom Donovan for all the great work he did for this exchange. But I'd like to say, as I said, it is my pleasure to be here with my counterparts from the Merck and the options exchange. You know, we hope we can provide a little bit of an insight. I'll give you a little bit of a historical background of the Board of Trade. We've been around for 157 years. Our history is very much intertwined with that of Chicago. We were founded in 1848 by 83 businessmen, and I've given this speech many times. We argue 82 or 83, but it was just 14 years after the Chicago was incorporated. They were smart men with a vision, and 6 of them were among the first 20 mayors of the city of Chicago. In the beginning of the Board of Trade's primary function was to remove some of the unpredictability of the agrarian economy. The Board of Trade provided a place where sellers were confident of finding the largest possible number of buyers, and buyers were assured of finding the largest number of sellers. Originally a grain exchange, the Board of Trade markets functioned as a way to smooth out wild price swings in corn and wheat. Farmers at the time were defenseless against the rules of supply and demand. Shortly after the harvest, when there was a tremendous amount of production, prices plummeted dangerously low for farmers. Then 9 to 10 months after each harvest, the dearth of wheat and corn drove prices up. In fact, one famous story illustrates the frustration of this volatility. In the middle of the 19th century, prices dipped so low that a group of farmers dumped their wheat into the Chicago River in protest. If they could not make a decent living off their crops, no one was going to. This was the start of formalized futures marketplace where participants buy and sell commodities for delivery at specified times in the future, as opposed to immediate delivery in cash and carry. Today, there's more than 60 futures exchanges globally, all of which are based to some extent on the Board of Trade's original model. Despite the added competition, the Board of Trade remains a leader and driver of change in the derivatives industry. Actually, I would call 2005 a milestone year in our history. Our IPO and all the activities surrounding the exchange's move to a for-profit company was a major story, not just in local terms, but nationally. We were ranked as the 5th best ever IPO in the New York Stock Exchange history and 2nd best for this year. The IPO was a major turning point for the Board of Trade as an institution. The exchange's restructuring and the subsequent IPO enhances our competitive position within the industry. Still, the basic foundation of the exchange, our beliefs, our values, the very purpose of our existence remains unchanged. The Board of Trade and its shareholders continue to hold tight to the basic principles of providing fair and liquid markets for price discovery and risk management to investors worldwide. And as significant as the IPO has been to the CBOT, there have been many other events and accomplishments that stand out in my mind for 2005. The exchange's solid performance in trading volume this year. In fact, on November 16th, we broke the annual volume record for the 4th consecutive year in a row, trading more than 600 million contracts with a month and a half to go. And I think we're the CME's largest customer as far as clearing is concerned, so he benefits by it too. There's also a recent release of major technology enhancements to our electronic and open auction platforms. We launched 2 groundbreaking futures contracts, the South American soybean futures, as well as our ethanol contract. We celebrated the 75th anniversary of the Board of Trade building, which is set there at LaSalle and Jackson, if you ever get the two of us confused. We kicked off an extensive building renovation and had 2 statues from the original 1885 Board of Trade building returned to us by the Forest Preserve District of DuPage. How they got there, I have no idea, but we got them back anyway. Additionally, the exchange has made a number of significant strides in the implementation of our global outreach initiative, especially in the Asia-Pacific region. We also recently found out that the Board of Trade will be honored by Global Finance Magazine as the best derivatives exchange for this year. But the fact that Terry and Bill can also run through their exchange's own list of achievements that are equally impressive, and I'm happy and proud to know that Chicago's derivatives business remains vibrant and strong, unlike other U.S. industries that have become minor players in the arenas they once dominated. Based on data from the Futures Industry Association, the total number of futures and options contracts traded worldwide on reporting futures exchanges grew from about 1.9 billion in 1999 to about 7.7 billion in 2004. That's a 300% increase. It's interesting to note that last year, about a quarter of that volume was generated by these three exchanges right here, the Mercantile, the Board of Trade, and the Board Options. I believe this combined volume makes Chicago the exchange-traded derivatives capital of the world. Our growing futures market support job creation for Chicago area residents, including banking, telecom, IT, and legal services. And there are other benefits the exchanges have brought to our area. Billions of dollars are constantly on deposit in Chicago banks to support these exchange-traded products. An exchange's impact on the local economy is often driven in part by its global reach. Rising international participation in futures markets has increased volumes and distribution of many of the Chicago Board of Trade's products. The recent and substantive growth in global futures and options on futures trading volume is attributable to a number of factors. There's an increasing awareness of the importance of risk management. There's greater price volatility in key market sectors. There's greater access to futures and options on futures markets through technology and innovation through technology. There's also been a relaxation of regulatory barriers. Technology has made it easier for market participants to connect to the exchange from nearly anywhere in the world, almost around the clock. While most of Chicago sleeps, Europe and Asia trade the Board of Trade's products via our electronic trading platform. We at the Board of Trade expect that the expansion of our electronic markets will continue to increase the exchange's business that is generated from the outside the U.S. borders, that is. The CBOT has launched an aggressive campaign to expand access to our markets from around the world. We're using every tool at our disposal with the heavy emphasis on technology. We also are focused more now than ever on our customers. We believe that globalization, increased sophisticated market participants, deregulation, and recent advances in technology and consolidation among market participants change the way both the futures and broader commodities and derivatives exchanges operate. This brings about significant opportunity. It is partially due to these relationships and outreach efforts that so many visitors come to the Board of Trade from around the world. They also visit us because the exchange's history is so closely tied to that of Chicago. Those that stop by our visitor center often choose to watch a movie about the Board of Trade, which gives an overview of what the exchange is. And nowadays, it's available in languages including Chinese, Portuguese, and German. Without fail, what really interests visitors at the Board of Trade is the sight of our markets at work. Our visitors see cutting-edge technology interacting with our open auction markets and traders executing transactions on electronic screens. And they learn about Chicago's style of capitalism, its history, and its impact on global business. Why do I believe that Chicago's derivatives industry continues to do so well despite tough global competition? I believe it's the Chicago Exchange's commitment to innovation. One of the key factors contributing to volume growth is what I consider the lifeblood of futures exchanges. It's the products that we offer. Making sure that CBOT products are relevant and viable to market users is a top priority of our exchange. We regularly review our current contracts while exploring potential for growth in new areas. I also think it has to do with the competitive spirit of Chicago exchanges. Competition encourages innovation and keeps businesses on their toes and intensifies the focus on customer needs. I've also found it to be a pretty strong motivator to have your competitors right next door to you or just down the street. Also, Chicago exchanges have a very strong customer focus in which we maintain a regular dialogue with our users and market participants. It is through these interactions on how we can better serve their needs that often is the spark for many of our most creative and successful ideas. Finally, it's Chicago's exchange's concentration on market integrity. One of the most critical issues for businesses is customer confidence. At the Board of Trade, we have a proven track record of maintaining market integrity and safeguarding our markets from manipulation and ensuring competitive trading practices for the marketplace. The unfortunate recent collapse of REFCO reinforced the benefits of the customer protections in place at the Board of Trade and the Mercantile Exchange. Not one Board of Trade customer or mercantile customer or a customer of a regulated futures exchange lost money as a result of this bankruptcy. It's 157 years without a default. It's pretty powerful stuff. We believe that market integrity is so critical to the continued growth and success of the futures industry that we are committed to teaching emerging markets the breadth of market surveillance and regulatory oversight necessary to establish market integrity, which is so crucial to inspiring investor confidence. Global marketplaces often turn to the Chicago Board of Trade as a benchmark of regulatory standards and practices. It is these factors, innovation, a competitive spirit, a strong focus on customer service, and maintaining market integrity that I believe keep our businesses vital and thriving. All of us at the Board of Trade are proud of the contributions we make to the world's economy and to the city of Chicago through our dynamic and innovative markets. I believe I speak on behalf of the entire Board of Trade when I say that we look forward to working with you to promote the city of Chicago. Thank you.
Quick interjection, so I don't get in trouble with my boss, Mr. Doherty. I left out something. For our last speaker, Bill Brodsky is the only person to head two major exchanges in Chicago. He headed the Chicago Mercantile Exchange for 11 and a half years, and he headed the Chicago Board of Options Exchange for 8.5 plus years. Now, he's not, I don't know if he's going for a three-bagger or not, so, Mr. Brodsky.
Thank you, Paul. I guess that's kind of an introduction to someone who was in the TV program The Survivor. In fact, the fact that I was first at the Merc and now at the CBOE makes me want to also acknowledge Leo Malamed and Jack Sander, who brought me from New York to Chicago 23 years ago, and I'm forever grateful for the opportunity that they gave me. I also want to acknowledge my colleagues at the other exchanges, the CEOs Craig Donohue and Bernie Dan, and my former colleague Tom Donovan. You'd be amazed, even though we compete with each other, there is a tremendous amount of collegiality that we develop because we understand what each other has to deal with, and we also have many issues in common. You'd be amazed the respect that the Chicago exchanges get in Washington because of the fact that not only are we innovative and we have good businesses, but because we're politically active and people respect us. And in fact, I would tell you that the Chicago exchanges have much more clout in Washington than the New York exchanges have because of the hard work that's been done over the years and because this is a group of people that know how to make politics work. Right, Jay? Where's Jay? Let me give you a little background about the CBOE. We're the youngest exchange, and the Chicago Board Options Exchange was founded by the Chicago Board of Trade at about the same time that the Merc developed financial futures. So the early 70s were a very important time in the history of financial markets, but particularly an important time for Chicago, because this was a time when these developments were occurring where they could have and should have occurred in New York. And I will tell you, I was in New York at the time. I was at the American Stock Exchange in 1974, and people in New York didn't believe that the people in Chicago could do anything with financial instruments. After all, Chicago's someplace out there, and it's agriculture, and it has nothing to do with finance. And to the great credit of the people in this room and others before them, they developed not only the innovation, but they developed a way to make it work and make it endure. And we are all beneficiaries of that today. The CBOE was a brainchild of the Chicago Board of Trade. It's a wonderful but difficult history because it took the Chicago Board of Trade 5 years, a lot of money, and a lot of doubts as to whether this could ever work. And on April 26, 1973, when the CBOE opened its doors within a smoking lounge off the Board of Trade trading floor, that's how modest it was, it traded 911 contracts that first day. And people were relieved that it worked, but didn't know what the future was. This industry, the options industry, which is separate from the futures industry, and I'll explain that in a few minutes, now on average days trades upwards of 8 million contracts a day. That's how big this business has become. And it's become a big business because it's fulfilling a very important function. When the Board of Trade created the CBOE, it also created a separate clearing corporation called the CBOE Clearing Corporation, very much like the clearing corporations that exist today. What happened is that the SEC, which regulates the options business as opposed to the CFTC, which regulates the futures business, used blackmail and probably would never pass a legal test over the CBOE and forced the CBOE to share its clearing corporation with the other options exchanges as they came on to compete with the CBOE. And as a result, the Options Clearing Corp, which is not represented here, is the largest option clearing corp in the world. It is AAA rated, and it clears all the options that I mentioned. What's significant also about that is, again, because the option business is under the SEC, the options that trade on our exchanges, the options such as Microsoft, Intel, IBM, et cetera, are subject to what we call fungibility, which means that if an option trades on more than one exchange, you can open a position on one exchange and close it on another. That makes our business a very, very different model than the futures business. And I'll explain a little bit about that as we go on. We are a securities exchange, but yet we're a derivative exchange. So CBOE, as opposed to the Merck and the Board of Trade, are in a very different situation. We have to deal with the SEC constantly. We have to deal with issues that relate to, say, NASDAQ and the New York Stock Exchange, and issues such as order handling, payment for order flow, internalization, that don't exist in the futures business. And at the same time, we have to deal in the derivative industry, which is really much more related to what the Merck and the Board of Trade do. So the reality is that we have a foot in each pond, and it makes it much more interesting for us, but sometimes much more difficult, because you're kind of not fish nor fowl. And it becomes an issue sometimes, and as I said, we work together in Washington, but sometimes we're at odds. And we're at odds because we're coming from different regulatory environments. We're the only major country in the world, save one, which is Australia, but every other major industrialized country that have options and futures markets have them under the same regulator. And it creates all sorts of issues that we have to deal with, and it's not because one is better and one is not better, but because these things developed historically differently. The futures world came from the agriculture area and are regulated by the CFTC, and under that, under the purview of the agriculture committees, and the option business is under the Securities and Exchange Commission, and hence under the Financial Services Committees. And there are turf issues and there are technical issues, and it is very unfortunate for our country that we have these issues that have not yet been reconciled. And really, it's an issue that it rests more in Washington than it does here in Chicago. I want to talk about three issues today that really are about where CBOE is going in the future. The first is our market model. The second is our business model. And the third, as my colleagues touched on, was about innovation, because that is the key to successful derivative markets. Let me talk about the market model for a minute. That is how we trade and what we're faced with. When I arrived at the CBOE in 1997, CBOE had exclusive listings in 27 of the 30 Dow stocks. And we had exclusive listings in many others, but just to give you an idea of the magnitude, we were faced with a Justice Department threat that we had to multiply list these products. And that's like having the government tell you that you have to compete with someone you don't want to compete with. Unfortunately, the Justice Department had a lot of clout, and we had to open up our markets, and we started off literally with 100% market share in 27 products. You can only go one way when you have 100% market share if you're competing, and that's down. The good news is that volume has made up a lot of it, but my point in telling you this is that we are under a very different competitive dynamic than the futures exchanges, because we compete head-to-head on our most active options, and it is very, very intense competition. The volume spread out among the 6 exchanges, where no one exchange has the lion's share of the business. It also gives the brokerage firms an opportunity to play one exchange against the other. And issues such as payment for order flow and internalization, which again are very much part of the stock market, mean that changes in demands by the firms cause us to have a lot of different issues that we have to deal with, which, quite frankly, make it very hard to run a marketplace as quickly as you'd like, because the SEC makes it very difficult on us. Recently, one of the greatest innovations of the recent past has been exchange-traded funds. You've heard of SPDRs, diamonds, triple Qs. These became very popular among investors. Well, what's also become very popular is options on these indexes. Now, in this case, because of recent court rulings, these are multiply listed. And to give you an idea of how dynamic and competitive our markets are, in the case of the triple Qs, which is the NASDAQ 100, ISE has a 32% market share. We have a 27% market share. Amex has a 15% market share. The Boston Exchange has a 10% market share. Philadelphia 8 and Pacific 8 also. In Spiders, we have a 39% market share. ICE has a 23% market share, and the rest have 10 or less. In Diamonds, we have a 51% market share. That's the most recent competitive issue. ICE has a 16% market share, and others in the same range. It just tells you how the different dynamic that we have to deal in. And Charlie mentioned that competing with people around the corner is difficult. Compete with people head to head, and it's a lot more difficult, Charlie, I promise you. Now I want to talk about the business model next. I give a lot of credit to our colleagues at the Merck and the Board of Trade for having gone first for profit and then demutualizing and ultimately for public, and not only going for public but with great success. One of the reasons that their success is so great is that they've shown investors that the business model of these exchanges really works. And one of the reasons it works so well is because of the exclusive listings that they have. And one of the goals that we have for the new year in January, we're beginning to go for profit, which is the same path that the others led down. We're going to go for profit and hopefully later on in the year demutualize. These are very important steps for us to take. But I will tell you, as I've told our owners, that the business model of these other exchanges and the market model is different because of the exclusive listings, and that's why I wanted to make sure that you understood the difference. So while I believe deeply that we should go for profit and demutualize so that we have strategic optionality and so that we have the ability to make strategic decisions much more quickly, the reality is that options exchanges have a different competitive dynamic and profit margin than futures exchanges. Nevertheless, we are proceeding. We've retained Goldman Sachs to assist us, and I would ask you to watch what we do over the next 12 months. It's going to be a very, very exciting time for the exchange. Now, finally, I want to talk about two things. One is the innovation that continues to take place at the CBOE, and then a little bit of a profile of why the option business has grown so much. First, on innovation. Even though there are 6 options exchanges in the United States, I would tell you that the bulk of the innovation continues to come out of Chicago. I'm very proud of it. It's a combination of our staff, it's our members, and the people that we work with in the community. We have adapted our technology. One of the things that we've done is created a hybrid trading system. A lot of exchanges have added an electronic component and they keep a floor component. We're the first exchange in the world to merge the two so that customers have a true choice. They don't have to go either floor or screen. They can pick as they choose because it all ends up in the same system and the same product. So, for example, on our hybrid trading system now, 90% of all the trades in hybrid products, which is all our equity products and our ETFs, 90% of the trades are done without human intervention. It represents 55% of the volume, which means that customers are still choosing the price discovery mechanism of the trading floor. I had the pleasure of having John Thain visit us a couple of months ago. They are talking about a hybrid trading system. But they, in their talk about the hybrid trading system, they decided to merge with Archipelago because they didn't have the technology to make them competitive enough with the electronic markets that exist in the stock market. So what did they do? They're merging to get the technology of Arca, but they're hoping to still save their floor through a hybrid system. When John Thain came to our floor, he left and he said, I hope we can do as well as CBOE has in developing a hybrid system. And by the way, at the time that he came to visit us, he made a speech at the Commercial Club of Chicago, and I'm delighted to have our lead director, Eden Martin, who happens to be president of the Commercial Club of Chicago, and it was at that speech that he said, I hope that we can have a successful hybrid system like the CBOE. And I would suggest that you watch what happens at the New York Stock Exchange. I think they're going to have a tough go of it. I think that the nature of stock trading makes it even easier to put the system on a pure electronic system and harder to maintain the hybrid system, except that on large orders, which is where we excel, that's where the New York Stock Exchange is going to have to make their hybrid system work. Other products that we've come out with lately are very exciting. One is that one of the most popular strategies in the option business is owning a stock or owning a basket of stocks and selling a covered call as a way of increasing your return and reducing volatility. We created a buy right index, which is an S&P 500 index. We now have one with the Dow. We now have one with NASDAQ. And the buy right index has become a benchmark for a subset of the mutual fund community that now has, in the last 18 months, over $15 billion in investor money for people who want to buy the S&P 500, in this case, and sell the calls on a monthly basis. And it's being done on a managed basis. It is very popular, and as a result, we get the business in the options because we're the only exchange that has an exclusive on the S&P 500 option and the Dow options. We created a little futures exchange, purely electronic, because we developed a whole new asset class called volatility. Sophisticated traders literally trade volatility, and we created a VIX future, which has started off in a very slow, small way, but it is driving thousands and thousands of contracts every day into our S&P 500 options. And most recently, we came out with weekly options. For those people who have no patience for an option that expires in a month, we have options that expire every week. And we introduced that in the S&P 500 and in our S&P 100, or OEX. Now, why is this growth growing so much? Let me tell you that year-to-date, the options industry in the United States volume is up 26%. CBOEs is up 29%. One of the reasons is that options can be used by customers, average customers who trade stocks or understand the stock market. And that we had a survey done recently, and it confirmed everything that we've seen in the past, but continues to grow because of the advent of technology. 87% of our retail customers use the internet through their brokers to trade options. I needn't tell you how that trend is continuing to grow, and our education that we've spent millions of dollars on through our website and other programs have given customers the tools they need. And this is not for just speculators. This is for any one of you that owns stocks to understand how options really can add to the value of your portfolio. As a result, our business is continuing to grow. As I said, we're up 29% this year, and I expect the growth to continue because with every passing year, more and more people understand options. So I'll conclude by saying that not only has the innovation started in Chicago, it continues in Chicago, and I see the future of our business is very, very bright. I thank you very much.
If you want to ask a question, please come to the microphone. Please don't ask for tips. Don't all rush up. You go off the microphone. You could just state your name, and that would be a nice way to start. Just yell. There you go.
Anyway, here we go. My name is Steve Condren, and my question is to Mr. Bratsky from the OEX, particularly as to trade OEX options. And a question I have is, why is the volatility or the premium level on the OEX options less than what is back in the 80s? I noticed a great diminishment on that option. Can you explain what I'm talking about?
You'd be a good customer for our VIX future.
Yeah, there you go.
It's all about vol, and volatility is down in the stock market, and volatility is going to be lower in indexes than it is going to be in individual stocks.
Because I noticed particularly after the big crash they had back in the 80s, when they had the 570-point drop.
Was there a crash in the 80s?
Well, I mean, on the, you know,
20s.
but I mean, but I noticed with the volatility, there was a diminished return as far as premium. So you're saying volatility is a key to.
Yeah, and you can now watch our volatility both by watching the VIX futures or just we publish it. The VIX became a benchmark for what's called the fear index, and when volatility's up, the premiums are going to be up.
Okay.
But the good news is that people are using these options as a way of, as I said, you can now sell calls
Right, cover call. I used to write cover
on an
calls.
OEX product.
Right. Well, you have a great product. I've done it for years. They're fantastic. Thank you.
Thank you.
Very good. Good question, good answer. I have a written question for any one of you. What percent of your growth that you all talked about is coming from hedge funds?
I'll answer, say, increasing. The amount of business that has come from hedge funds has grown dramatically for two reasons. One, there's more hedge funds, there's more money in hedge funds, but also because of the electronic accessibility of our markets. Because of the competition in our markets and because we post our bids and offers and the size electronically, hedge funds and other large investors can do enormous amounts of volume at the bid and the offer, firm bids and offers, which they couldn't in the past. They have to go in the pit, they negotiate, they get beaten up. It doesn't work like that anymore. If you want to sell 500 and it's offered at 500, you press the button, you're done. And so that the liquidity that exists in these markets, both ours and at the future side is so much greater than it ever was that it just the volume begets more volume. The more hedge funds that trade, the more volume there is, the more liquidity there is. So it continues to grow, and I believe that as more money pours into hedge funds, it will continue to grow. And it's bolstered by the fact that, given the REFCO situation, it's just another affirmation of why people should use our markets with the clearing guarantees that we have, because people have the confidence they do a trade, they don't have to worry about who's on the other side.
Paul?
Good.
Bill answered the question, but he also made a couple other statements, so as long as he opened that up, I'm going to use the opportunity to do the same thing. At the CME, we cannot measure exactly how much the hedge funds business have grown, but we do know that we now allow them as clearing members, and we have seen a huge increase in the number of clearing members that are hedge funds. Saying that, Bill, actually, I don't want to turn this into a debate, but one of the things that he had said earlier.
I'm ready.
All right, good. As long as you're ready. One of the things you said earlier, the reasons that the CME and the CBOT have become successful as IPOs because they have exclusivity on their product. That's one of the farthest things from the truth. One of our largest products in the world is Eurodollars, and we do not have exclusivity on Eurodollars, which is, as you know, one of the largest products in the world. So that's the only reason we're not successful, just because we have exclusivity. I believe one of your largest products, you just mentioned at the end of your speech, is a licensed product.
Hey, I'm jealous. I wish I had more
I would be
exclusive
too.
products. But what I was really referring to, and maybe I mixed the two concepts, is yes, exclusive products certainly make it easier in terms of competition because you don't compete head to head. But in non-exclusive products that you trade, there's no fungibility with another exchange who wants to compete with you, as we have in our market. I mean, ISE came out of nowhere 5 years ago, but they were able to attach to the open interest that we had through the clearinghouse, and all that we had built up over the years was theirs for the taking on day one, and that made it much more difficult and continues to do that.
You want to get into this?
I feel like I'm in front of the Senate Banking Committee. This is how they respond when somebody.
Just remember, this is a city club. Now, granted, we don't have these many debates with this kind of dollars on the table, but go ahead.
No, as to the other question that was posed, hedge funds, while we don't have an absolute number, we've obviously benefited from the introduction of hedge funds, and I think also the fact that commodities are now viewed as an asset class, which is used to basically enhance portfolios. So I think we've benefited from both those factors.
I'll be happy to start it. Obviously, technology is always a huge challenge for any institution. We are a technology company today, as well as a financial services company. So technology is something that we have to continually be very cognizant about. It's a huge part of our spend. We have close to 1,400 employees at the CME. Over half of our annual budget is dedicated towards technology. As I said in my opening remarks, 75% of the business is now electronic. That number is growing, not going down, it's going up. So technology is a challenge that we have to continually be aware of.
I would just say that we have to manage against complacency, which is what can creep in when you're having success like this. But I honestly think one of the biggest challenges in front of the exchanges is there's going to be a lot of pressure to consolidate, and basically that process and those decisions are probably going to be the most challenging facing the exchanges.
Our biggest challenge is that, as Terry said, technology is key to all of this, and as I said earlier, we have 6 exchanges that we're competing with head-to-head on our major products, all the individual equity options. So it's a constant, no matter what advance we bring in today, it's never good enough. You always have to worry about the next thing tomorrow. And I think one of our biggest challenges is that we are under the jurisdiction of the SEC, which is very, very difficult. When I talked earlier about the fact that we're under the SEC and the futures exchanges are under the CFTC, even the statutory framework is so different. When we want to make any substantive change, and I have my lawyers here, they can confirm it to you, it takes weeks and sometimes, not weeks, it takes months and sometimes years to get the SEC to approve anything. The futures exchanges have very wisely been able to get changes in legislation, which has made it much easier for them to make changes, and they should, because they should have the agility to make the changes. We are trying to get the same changes done, but the SEC is very big, very difficult, very resistant to change. So they're operating under a statutory framework that was designed when exchanges didn't really compete with each other, and we're now in the competitive world, and they haven't changed the framework, and we are working with Congress to try to get that done. Only time will tell if we'll be successful.
One Another question I have here, and I think the author is here, as my sometime employer, Crane's Chicago Business, you guys have sort of become the poster child, you know. You're giving a nice young Kate Ryan. And Kate, you here? Raise your hand. Don't be embarrassed. She left. Or she's too much of a coward to raise her
Then you
hand.
can't ask her a
But,
question. If she left, you can't ask her a question.
But the issue that has been raised about investors want to see agricultural contracts traded on computers. What's the story on that? That was a couple of weeks ago, there was a...
I think I own that question because his ags are on there. And Bill, are you trading ag futures yet?
Not when I left the office.
No. So I
Go
think
right
that-
ahead. Go.
I think that was directed to the Chicago Board of Trade. And I would say that right now, agricultural futures are listed electronically from 6 in the evening till 6 in the morning. They're not currently traded in a side-by-side fashion. But the management and the board are committed to always assessing the demand for these, and if the demand is to appear, then I think we would make that decision. But right now, there's no announcements today. Okay.
Well, how about a big round of applause? This was...
Well done.
Before you all run off and go to your computers to make your investments, we have 3 mugs. You guys divide them up. They're all the same. We've got 3 one-year memberships, and given how well you're doing, I assume you'll come out with the big membership. And 3 histories of the City Club of Chicago. And before we adjourn, a personal moment. There's no way I could let this go by. I've known this individual for most of my life. He's a longtime boyhood friend of my uncle, and that's Leo Malamed. And it's good to see you again, Leo. Thank you very much. We are adjourned.